Hello, everyone. I hope you are all good.
Hello.
Today we're gonna start. Actually, I received some requests to go the questions. Actually, on my own, I forgot to solve the questions at the end of the chapter 3. Like I asked you to do the activity part, like from question 19 to question 26. Okay, 26, 27. So I will go over these questions. Then I will move to the questions, which is at the end of the chapter 4, the measure of the leverage. That chapter actually pretty easier, but this one is a bit not complicated but challenging. So starting with this question 1, question 19, the thing that we did not do it. So we are given the information in here, like Boris Doorte is CFA that covers initial public offering for Zellweger Analytics, and it's an independent research firm specializing in the global small cap equities. So he also asked to evaluate the upcoming new issues. So based on the US business intelligence software company. So they are given some, this is not the publicly offered company, traded company, but there are some comparable companies that are provided here, like Relevant, ABG, and Opus software. But they're located in different countries, but they're in the same industry. So here the question 19 tells you the asset beta for Relevant, ABG, and Opus respectively. So we are asked to calculate the asset beta. Okay, we are given the equity beta, but we need to calculate asset beta first of all. And asset beta is equal to equity beta over 1 plus 1 minus tax times debt equity ratio. This is what we know from it actually. So let me just open this and type it here. So asset beta is equal to equity beta divided by 1.
No, it is multiply.
No, it's division in asset beta. For finding the asset beta, we need to divide it. Just be careful, okay? When you find the equity beta, it's different. One minus tax. And thank you so much for following me and correcting me. Just recheck it, just in case.
I think I solved with multiplication and I got correct result.
Okay, we'll come to that point, just a second. Let me just recheck it, just to be on the safe side. Yeah. Actually, it's division. This formula is the same with this formula, as you can see here. Okay, this is what in here you just beta equity multiplied by 1 over 1 plus, but I'm making equity beta just above it. Okay.
Okay, I got it. Yeah. I used above formula.
Okay.
Multiplication. Yeah.
Okay, I got the clarification. Thank you. Thank you so much. So it sometimes can happen that I might be mistaken. I'm a human being. There's no, so it's good that you're following me. So asset beta is equal to equity beta divided by 1 plus 1 minus tax and divided by times by debt equity ratio. So we need to calculate asset beta for each firm, like for Relevant, ABG, and Opus. Relevant beta is equal to, we are just going to substitute the numbers. Everything is provided, like equity betas are here. Okay. 1.702 divided by 1 plus 1 minus 0. And the tax rate is 23%. And debt equity ratio, are we given any debt equity ratio in here? It says 0 debt, okay? It says 0 debt. So which means times 0. And it's just straightforward, okay? We just substitute the numbers and we get whatever we have it here. And if you calculate, you should get 1.702. And we have ABG, which is 2.8 divided by, okay, I'm just gonna copy this, not to waste the time. And this actually, 3. How I get it? I get it from debt divided by equity. Okay, this will give you the equal to 0.003. And there has some numbers, but I'm just considering after the dot like 3 decimals. And that should give me actually 2.79, 18. And for Opus, we've got 3.4 times, divided by 1 plus, and in here, the debt equity ratio is equal to 4.013. And if you just calculate, you should have got 3.3663. This is what I get it. So my answer will be in here, B. In here, they're roughly rounded, okay, 1.70, 2.79, and 3.37. Roughly rounded. Okay. That's what I get it. Now I move to the question 20. So we're given betas here. They weighted the average asset beta for pure play players in the industry. Relevant ABG and Opus weighted by market value of the equities close. So we need to calculate weighted average of the asset beta, weighted average, okay? So what we need to do here, we need to get the first of all the weights, the proportions, and then we just multiply whatever we get it. We need to get the proportions of market value equity, and that will help us to find the weighted average of the beta. So each market value proportion times by the asset beta that we calculated, and summing up will give you the beta average. So what we do here, we calculate the proportions. To find the proportions, like having the pure play and we say the relevant, then ABG, and we have Opus. For the relevant, the equity market value are given the above, which is 3,800 million. And for ABG is 2,150. And For Opus, it should be, I forgot,
972.
972. Okay, now we need to find the proportions of the total, and the total amount is, if you just sum it up, this all 3,800, 2,150, 972, it should give you 6,922. This is total amount. And finding the proportions, okay, finding the proportions is 3,800 divided by 6,922 would give you 0.54, like 54% 90. And same thing we do for the ABG, 2,150 divided by 6,922, which is 0.3106. And we do the same thing for Opus, 0.972 divided, 972 divided by 6,922, and it should give you 0.1404. So these are the proportion we found it, the weighted measures. Then we just correspondingly multiply the relevant weights with the asset beta that we found for the relevant company. That would give us, and we're going to sum it up, and that's going to give us actually, so 0.54 times 1.70 plus 0.31 times 2.79 plus 0.14 times, I'm just abbreviated, I'm just considering two decimal numbers just in order to write it quickly, not to spend the time on typing. 3.37, okay, just round it up. And this weighted average should give you, if you calculate, the weighted average of beta would be equal in this case 2.27. Okay, this is we used to find the beta average. If this information is not given, what would you do? You could just get the average of this beta, okay? You will just sum them up all and divide by 3. Okay? This is weighted average. Moving to the question 21. Having this all information calculated, using the CAPM model, the cost of equity capital for the company in this industry with a debt equity ratio of 0.01, asset beta of 2.27, which we calculated, and marginal tax rate of 23% is closest to, so we need to calculate the cost of capital, cost of equity, using the CAPM, like risk-free rate plus beta times the equity risk premium. Are we given equity risk premium? Yes, here we go, 7%. Risk-free rate is given 5.25, so 5.25 plus 2.27 times 7%. So it's just straightforward calculation.
I think we should do leverage beta, no?
Yes, it's a leverage beta. It's a leverage beta. So 2.27 is average beta. Actually, these two questions are correlated. They're because in order to find the 21, you need to find the unlevered beta. Okay, we find in the here unlevered beta, then you're right that you're saying that we need to first find the levered beta. So here we are finding the levered beta. I just directly jump to the cost of capital, okay? Cost of equity is equal to 5.25% plus the beta, but this is the actually levered beta, times the equity risk premium, and which is 7%. And we don't know the beta, the levered beta, so we need to find the levered beta. So levered beta will be equal to, we found already for pure play through the pure play method, the average beta, which is 2.27. We just substitute into the formula that we have it, 2.27 times 1 plus 1 minus 0.23% the tax rate. And this time the equity debt equity ratio, which is given above as well, is 0.01. And that would give us actually 2.2875, the levered beta. Now we can just substitute this 2.275 cost of equity, 2.2875, and that would give us the cost of equity equal to 21.26%, and which is the closest is B. But in the exam, I will give you more accurate numbers. I will try to not to get the rounded numbers. Okay, while you'll be solving, please be careful in the question you have it here. So the answer is B. Okay. Question 22. The marginal cost of capital based on the average asset beta, which is 2.27, for industry, assuming the new stock can be issued at 8 per share. So we are asked to calculate weighted average cost of capital. It is the same name as marginal cost of capital. So we need to know what is the debt equity ratio. We need to know the proportion of debt and proportion of equity. We need to estimate cost of debt, cost of equity separately, having the information given above, and so on. We will do it through using the YTM approach. To use the YTM approach, we are given the table in here. The currently outstanding bonds are given here, and some shares are outstanding and some shares are newly issued here as well. So we'll take this into consideration. So equity and debt. So first of all, we need to find the cost of debt before the tax, Then we will find cost of equity, and of course we'll try to find the debt weight and the debt equity. So the debt weight and equity weight, I mean the proportion sides, in order to calculate weighted average cost of capital, having this information. So first of all, to calculate the cost of equity, you need to calculate the YTM, and you're given the information. It says here, okay, here, currently outstanding 2.4 million 5-year bonds with a coupon rate 12.5%, with a market value of 2.156. So in here, you need to find the YTM in order to come up with the cost of debt before the tax. Okay, let me use it here. So to find the cost of debt, but what you need to do, you need to just use the Excel file. You know, the best thing what I can do here, I just type here. Because in Excel I can easily calculate. I calculated many times, but I'll do it one more time. So we have face value, we have bond value itself, We have payment, which is coupon payment. We have number of periods. So face value is 2,400,000. And the bond value is 2,156,000. The payment is 0.12.5% times face value. And the number of periods is 5. Now you need to calculate just rate. It's just straightforward calc, but before calculating rate in Excel function, you should be always keeping the negative sign of the bond value. It's just Excel issue, calculating the rates and calculating the future and the present value. So we just estimate the rate. You can use the financial calculator as you wish. So number of periods is 5. The payment is 300,000. The print value is this one and face value is this one. That's it. And we just press enter. This is our actually rate or cost of debt before equity or before the tax, sorry, 15.57. So our cost of debt, that's my question. So cost of debt, I found it. Now I need to find actually the cost of equity. I need to find the cost of equity. To do that, I need to know debt and equity part. I know the debt. The whole debt is equal to 2.156 million, but I don't know equity. But I know that 1 million of shares new issuance and 1 million of shares already outstanding. So in total, I have how many shares then?
2 million.
2 million shares. And at what price it will be traded? It says here at $8 per share. So my equity value will be equal to
16 million.
16 million. Very true. So putting the things here, so I have cost of debt that we calculated is equal to 15.57%. My debt is equal to 2,156,000. My equity value is 2 million times by 8, which is equal to 16 million. Why 2 million? Because 1 million shares newly issued and 1 million shares already outstanding. This is my equity value, okay? And now I can find the leveraged beta for my company. So leverage beta is equal to the weighted average of the beta that we already estimated, which is 2.27, times 1 plus 1 minus 0.23, the tax rate, and times debt over equity, which is this divided by this, okay? 2,156,000 divided by 16 million, okay? And that would give us, I'm ignoring these 3 zeros, okay? I'm just eliminating, just 3 zeros. I'm just eliminating the thousands. And that should give us, if you calculate, anyone remember? I don't know. I don't remember. Just a second. Let me just calculate. Oh wow.
2.511.
How much? 2 point.
2.511.
11.
Yeah, 2.511. Basically 2.5. It's okay.
Okay, let's make it 2.5. Okay, 2.5. Let's make it 2.5. Now Once we found the cost of, we found actually the levered beta. Now we need to find the cost of equity. My cost of equity using the CAPM model, like risk-free rate and beta times equity risk premium, which is 7% in here, as you can see, 7% equity risk premium. So 5.25% plus equity premium, sorry, the beta is 2.5 times which is 7%, the equity market risk premium, and that would give us the cost of equity equal to 22% and 7, yeah, 9. And this we calculated cost of equity, cost of debt. Now we can calculate what do you call the proportion of debt? Debt divided debt plus equity. It's very easy to calculate. The debt is here, the equity here, like 2 million plus 16 million divided by, or 2 million 156 divided by 18 million 156. Okay, this is proportion of debt, 0.11%, 87, and proportion of equity, 1 minus this, 0.8813. Now we can calculate the marginal cost of capital or weighted average cost of capital is equal to 0.1187 times 0.1557 times 1 minus 0.23 plus 0.8813 times 0.2279, and that would give us the marginal cost of capital equal to 0.21 and half, like 21.5%. Okay. In 22, the answer is C. Okay. Do you have any questions?
Yes, Professor, why in the answers they use N and PMT, they convert it to like 2 times in year, like they multiplied N by 2 and PMT divided by 2.
Did they?
Yes, but
Okay.
it's not written in the text. I don't know why.
Wait, let me check it. And I'll tell you. Let it be like this. The page is how much? 46, so that I don't get confused. This one, yes?
Yeah.
They assume they made the assumption like it's semi-annual. You see, the number of the period is converted to semi-annual basis. The payment is converted to semi-annual basis. But there's nothing has been said about the semi-annual issue.
Yeah, that's the thing.
Okay, this is not correct. This is not correct. Okay, that I solved it is correct, but this one is not correct. They should have mentioned that it's semi-annual, but it's not. But still, you can actually, if you make it semi-annual, if you consider everything correctly, you still get YTM equal to this number.
Yeah, almost the same.
Yeah. But follow my way. If it's mentioned it's semi-annual or quarterly, then apply it. If not, don't do this.
Okay.
Now, question 22, we solved it. Question 23, 2 years ago, the company issued 20 million long-term bonds at par value, coupon rate 9%. The company decided to issue an additional 20 million bond and expect the new issue to be priced at par value with the coupon rate of 7%. So the company has no other debt outstanding, has the tax rate of 40%. To compute the weighted average cost of capital, the after-tax cost of debt should be, now we need to calculate the after cost of debt. So the cost of debt after the tax using the YTM. But in here, you don't have to make any calculation, straightforward, okay? Is what you given here, the tax rate, and the coupon rate is 7%. Then your YTM is what? If the bond that you issued, 20 million bond, is you're issuing at par value. If the bond value and the par value are equal, your coupon rate and YTM are equal as well. So your YTM is 7%, and YTM, when you tax it, like 1 minus 7% is taxed like times 1 minus 40%. That would give you 4.2%. Okay. 7 times 1 minus 40%, and this is 4.2%. Why 7%? Because the bond value is priced at par value. So when the bond value is equal to face value, that will make your coupon rate equal to YTM. Okay, is that clear? Yeah.
Yes.
It's just very easy question. I mean, just need to read it. You don't have to even to calculate. So question 24, the analysis gathered the following information about the company and the market. So we are given here. So using the discount cash flow approach, cost of retained earnings or cost of equity for the company is closest to. So in here, we need to calculate the cost of equity. So analysis found the information, okay, using the discount, the cost of retained earnings for the company and cost of equity. Okay, we are given current market price, dividend, expected return, dividend payout ratio, and 1 beta for the common stock and expected return for the rate. Okay, first of all, in this question, you need to find the expected return, okay? The expected return. But here they say find the cost of equity. Using the capital as price model, using the discount cash flow approach. Okay, now there are 2 different approaches. One is discount cash flow approach. The other one is CAPM approach. Using the discount cash flow approach. Now, okay, I got the question now correctly. Now, using the discount cash flow approach, we need to find the expected growth. Sorry, expected return. Let me just type it, not to forget. So we are finding expected return. Okay. The expected return is actually equal to dividend yield plus the growth of the dividend. Dividend yield plus growth of the dividend. This is the formula from the Principles of Finance. To find the dividend yield, it is dividend per share paid divided by price of the share. And the growth, I will name it as G. The growth, or it should be a small letter actually. The growth of the dividend, it is ROE, return on equity, times 1 minus payout ratio. Payout ratio, the growth of dividend. So now we are given 3 different formulas, but eventually we need to find the expected return. That expected return actually is all about the cost of equity using the discounting cash flow method. Okay. Now we've given dividend yield. We can calculate the dividend yield. The price is given. The dividend per share is $2. Dividend is $2, D0, but it should be D1 actually, D0. And the growth rate is, okay. First of all, let me just figure out D1, and this is P0. And the price, the current market price of the per share is, this is how it should be. Then we need to calculate actually D1 as well. And D1 is equal to D0 times 1 plus G, and to the power of T actually. To the power of 1. Because D1 and 1. Okay, now let me put it this first, then I'll proceed in this way. So to find the D1, we need to know G. In order to find dividend yield, then we need to first find the G itself, the growth of the dividend, by how much dividend will grow. So we are given here the return on equity, 15%, times 1 minus payout ratio, how much money paid and how much money retained. So the payout rate is 40%. That means the retained ratio will be 60%. And G will be equal in this case, if you calculate 15% times 60%, 60% of the 15%, which is actually 9%. Now we know the growth rate, and if you just calculate 2 times 1 plus 0.09, and your growth rate will be equal to 0.18. Now your dividend yield is 2.18 divided by 28 will give you, calculate 7.8% in terms of percentages directly. So then we need to just put everything into expected return, like dividend yield plus the growth rate of the dividend. So 9%, sorry, 7.8 plus 9, that would give us 16.8%. 8%. So the answer is in here, C. This is using discount cash flow approach. Actually, I have not taught you this, but anyway, here we go. Now you know how to get it. I just introduced you in the chapter, but I didn't give you an example of it, but now I gave, here's the example. So discount cash flow. Any question regarding this? Okay. Now we're moving to the question 25. Using the CAPM model approach, find the cost of equity or cost of retained earnings for the company. So using the CAPM model is just straightforward. Risk-free rate, 4%. Beta is 1.3. Expected return on market portfolio minus risk-free rate, 13 minus 14. So what we do here is just very straightforward. So cost of equity or CAPM is equal 4% plus 1.3 times 13 minus 4. That would give us 15.7%. The answer is B. And question 25 done. Question 27, no, 26, sorry, 26. So analysis gather the following information of the private company in the publicly traded comparison. So private company and public company here. Using the pure play method, estimate the equity beta for the private company. So you need to estimate the private company beta. So first of all, coming to the asset beta for the public company, I mean for unlevered beta, you need to get the unlevered beta. Just a second. Asset beta. It's very straightforward actually. 1.75 divided by 1 plus 1 minus the tax rate in here actually. So for publicly traded company, we need to consider tax rate, which is 35%. And debt equity ratio in here, 0.90. Close the bracket. That would give us asset beta equal to 1.104. And we have now chance to calculate the levered beta or the project beta that we're trying to estimate using the unlevered beta or asset beta. Just substitute everything into formula 104. And I'll just copy this part. Times 1 plus 30. Oops, it's not correct. And my debt equity ratio is 1. And this would give me actually, if you calculate the levered beta, 1.87, 1.87. And coming to the question 27, for an analysis gathered the following information about the capital markets in the United States, in Paragon and developing country. Okay, based on this information, The now stated estimate equity risk premium for Paragon. Okay, now we are asked to estimate country equity premium. Okay, just skip this question. You're not responsible because I have not covered it and I have not talked about the country risk premium. If it's given, you're going to use in expanded CAPE model, but you're not responsible to estimate the equity premium itself, country equity premium. So you're not responsible for the question 27. Let me take the note then.
We will not have on quiz, right?
Yeah, sure. In the exam, you're not responsible at all.
Okay.
Question 27, just cross it. Okay, this is we done with the questions of chapter 3. Is there any question chapter 3? Okay, that seems that everything is clear. Now we can move to the question that is related to the chapter 4, measure of the leverage. But this chapter is very, very straightforward using these formulas. Okay, I'm not going to solve the theoretical ones, but I'm going to concentrate more on the calculation part, like starting with the question 3. So Fulcrum company produced the decorative studio platform for the home televisions. If the Fulcrum produced the 40 million units, it estimates that it can sell for 100 each. The variable production costs 65 per unit and production costs 1.05 billion. Okay. And which of the following statement is most accurate and holding all else constant, like ceteris paribus? Generate positive operating income if unit sales increase by over 25 million, have less operating leverage. The 10% greater than this and generate 20% of operation. So basically we're dealing with DOL, degree of operating leverage. We're dealing with DOL. Like Q, price minus variable cost, times Q divided by Q times price minus variable cost minus financial fixed cost. So all the information is given here. You just need to just plug it into formula. So DOL is equal to, our quantity is given in here 40 million units. Okay, 40 million times the price is given here, which is 100 each, and the variable production cost is 65. So 100 minus 65, and it's all divided by oops. This minus the fixed production cost, which is 1.05 billion. And if you calculate, that should give you 4. So if DOL is 4 and unit sale increases by 5%, unit sales increases by 5%, if unit sales increases by 5%, if unit sales increases by 5%, then operating earnings expected to increase by 4 times by 5%. So the expected earnings expected to increase by actually 20%. So we can come up with the conclusion that 5% increase will bring greater than 40 million, will generate 20% of expected return. So this is the definition why we need to calculate the degree of operating leverage in order to calculate how much it will increase your operating income if unit sale increase by some fixed percentages. Question 6. The Myndia Motors now sells 1 million of units per unit, and fixed operating costs are this much, and variable operating cost is this much per unit. And if the company pays 410 million in interest, the level sales and operating break even. So the levels of sales at operating break even and the break even points are, so we need to calculate operating break even and the break even point itself. So the formulas are given here, like operating break even and break even points. So we need to use these formulas. Operating break even units will be equal to, so fixed operating costs per unit is 1,290,000 and variable operating cost per unit is 1,500 million. So what we do here is just we need to do make the division of, one more time, the formula is here, sorry. Price minus variable cost, and this is fixed cost plus cost. So much. 5. So my fixed operating costs are 1,290,000. 1,290,000, and I have I have any other costs than this, so I will just use actually the price minus variable cost, which is divided by price 3,529 minus 1,500. But one thing you should keep in mind is 1 in millions. So that would give me actually let me check. It is 635,078 units. 35 781.173 units. And operating break-even sales is equal to 3,529 times, let me record it here, and this is the 243. this much of the sales, it's in terms of currency, yuan, or it's Japanese yen. It's Japanese yen. It seems like it's Japanese yen. Okay, it's 2 billion something. 2 billion and its numbers. So this is operating break-even sales. So how much you need to sell in order to be at the break-even point in terms of currency, and how much units you need to produce in order to be in break-even points. So the question is asked here, what is the operating break-even? And break-even points are break-even points. So my operating break-even here is actually, but I didn't calculate the break-even points. So let me just calculate. So total break-even in here actually will be equal to total break-even following the formula above, which is given. Let me show it again to you. You're going to use the formula. Fixed cost, interest, or any other cost that you have it, divided by price minus variable cost. So we estimated operating break-even. Now we're just estimating total break-even only. So total break-even, it's actually fixed cost plus if there's any other cost like interest, we are adding it like 1,290,000 plus 410 million. And this all divided by price minus variable cost. 3,529 minus 1,500. That would give me, actually, if you calculate, $837 by 1. So my break-even point is 837, and operating break-even sales. But this is my break-even point, and my break-even sales need to be converted. So 3,529 times 837, 851, 2. That would give me 2 billion something 956. So my operating break-even sales here and break-even sales here. And now I can just say that it's B. One more time. This formulation is break-even point, is the last part that I solved it. This is the part. Like fixed cost, some other cost like interest is this one, price minus variable cost. And then to find the break-even sales, price per unit times by the number of the units at the break-even point. And operating break-even point is this fixed cost divided by price minus variable cost. And to find operating break-even sales is this one. Price per unit times by break-even units. Okay. Question 6 is done. Now we're moving to the question 7. Question 7, I have Juan Alavanca is evaluating the risk of two companies, machinery industry. And everything is given, like gearing company and help company. Based on this information, the break-even points for the gearing company. And so we're asked to calculate on a break-even point using the above formula, like fixed cost plus some interest cost and divided the price minus variable cost. So for each company, we need to calculate separately. It's just straightforward. You just put it everything into formula. Let me do it very quickly. So for first company that we calculate, this is company. The fixed cost is 40 million. Fixed financing expense, like interest expense, is 20 million. So 40 plus 20 and price minus variable cost. Price and variable cost. Okay, very easy. So 40 plus 20 in terms of millions, okay? And this all divided by 200 minus 120. That would give me 750,000. Break-even units for first company and second company. I do the same thing. 90 million plus 20 million divide by 200 minus 100. That would give me 1,100,000. So now 1,100,000, what we found it, we can just compare. And it seems the part we select is A. 750,000 and 1,100,000 units respectively. So it's a straightforward calculation. Now we're coming to the question 8. Okay, we're given some information using the question 8 to 16. And we're asked to do actually evaluation. I'm not going to read all the questions. You're expected, it seemed that you read everything. So question 8 is theoretical 1, I'm skipping. 9, I'm skipping. 10, I'm skipping. Okay. Now I will go with the question 11, the calculation part. First of all, based on the information exhibit B, degree of operating leverage of 4G. So you need to calculate the degree of leverage. Okay. Unit sales of 1 million. So degree of leverage using the same formula, DOL, like Q times price minus variable cost divided price by the Q price minus variable cost minus fixed cost, fixed operating cost. So what we're doing here, Q is 1 million. $1 million times 1 million $108 minus 72 variable cost divided by the same and minus fixed operating cost, which is 22 and 500,000, 22 million 500,000. And if you calculate, it should give you 2.67. where did I get this number? Just go up so you can see it. So 1 million units here is given for G, and sales price unit is here, variable cost is here, fixed operating cost is here. That's it. You just substitute the numbers, nothing more. Question 12. Calculate degree of financial leverage. The difference between the degree of operating leverage and degree of financial leverage is that you're in here subtracting not only the fixed cost, but financing cost as well. And in the numerator same, you're subtracting the fixed cost. So everything we do according to the formulas, okay? Everything we do according to the formulas. So in here, I do subtract. Let me put this brackets. And from here, I subtract the financing cost, and the financing cost is 9 million. If you calculate this all, you should have come up with 3. Okay. Just straightforward, directly putting everything into formulas. Now, question 13. Question 13 is actually you're asked to calculate expected percentage change in operating income. Is about DOL, degree of operating leverage, times by percentage change in units sold. So we are having here what is given. So we need to proceed to the question and to find what's going on. Here we go. Expected unit sold increased by 15%, and degree of operating leverage is by 1.4. So everything is given here. We will just use it. DOL times this, you will get question 13. So 1.4 times 15%, that would give you 21%. So it's B. And break-even quantity of unit sales, it's very easy. Same thing that we are using, same formula, like fixed cost plus interest cost minus price minus variable cost. It's 22 million plus 9 million divided by 109 minus 79. So that should give you, let me calculate, show you again. So 22,500 minus 9 million, and this all divided by 108 minus 72. This should give you 875,000 units. So this all information is given. This is break even. And question 15. In response to the question regarding the increase in the unit sales above 2009 unit sales level, most likely 4G's net income will increase at slower and lower rates than Q phones, the same rate as the Q phones. So first of all, we need to calculate degree of total leverage, which is Q times price minus variable cost over Q times price minus variable cost minus fixed cost. It's the same formula that we had it here. Okay, we are almost running the time out, but anyway, I'll be able to finish it. So we need to use the degree of total average. So degree of total leverage is actually equal to, here we go, where is it? We had, it's DOL times DFL. That will give you the degree of total leverage, first of all. And this is degree of financial leverage. Okay. Again, same, you just substitute everything into the formulas, all the numbers that are given here. Like the degree of leverage, operating leverage is given, degree of financial leverage is given in the question above. Here, operating financial leverage. And what you need to do is just substitute the numbers like 1.4 and 1.15, which will make your degree of operating leverage, degree of total leverage equal to 1.62. And it shows that the 4G's net income will increase at faster rate than Q funds due to the higher of the degree of total leverage income. Okay, I'm done for today, but I will let you go before, let me take quickly the attendance, and then I'll let you go. I'll get your like 2-3 minutes. Just give me a couple of minutes and I'll. Oh, anyway, I just gone. I skipped the attendance. Anyway, I will not take any attendance today. You know what could be the best thing? I will just type in chat as yes. That's it. Just type yes in the chat. That will be more than enough. I'll count it as attendance. And you can leave the conference. Thank you so much.
Thank you too.
Thank you, Professor. Bye.
Thank you, Professor. Bye.
Thank you, Professor.
Thank you, bye.
Bye. Take care, guys.
Professor, sorry.
Yes.
There are two Baglans. I am another one with T1.
Baglan.
Tleshov. I am Baglan Tleshov. I
Okay.
don't write my surname in name.
In
I
the
don't know
Zoom.
how to change.
Okay, you
Yeah,
put
I
the
don't know
Baglan. Okay, yeah, you have got your student number. No problem. No problem.
Yeah, okay. You can follow by my student number.
Okay, thank you so much, Baglan.
Okay,
for the
see you.
information.